Hi class, and welcome to Accounting 332, the online version. Remember, this is my classes online, virtually independently directed for the next 19 days, or as I like to call it, the COVID-19 plan. I want to start by reviewing what we covered for accounting for investments last class. Accounting for investments is tricky because we have 6 different classifications. 3 are dependent on whether we're talking about investing in debt, and 3 are dependent on whether we're talking about investing in equity investments. And the classifications within those 2 different types differ depending on whether we're talking about debt or equity. So essentially we have 6 separate accounting treatments for investments. Let's start with the investment type. 3 different columns here. Each investment's valuation on the balance sheet. And what else are we typically concerned about every single day that we're doing intermediate accounting? Balance sheet and income statement effects. The first investment type that we discussed was debt investments. Let's start with our 3 types of debt investments. And within debt, let's first start with our debt investments that are held to maturity. By debt, typically what we're talking about is investments in bonds. So one company, we did the accounting for bonds from the lender's perspective. Now we're talking about this from the lender's before we've talked about it from the borrower's perspective. Now we're talking about these bonds from the lender's perspective. So if a company has excess cash, decides to invest it by lending to a company or investing in another company's bonds, they might decide to do it so that they can collect periodic interest payments until those bonds mature. That could be 10, 20, 30 years. Now, daily, those bonds, the market values of those bonds are going to change as market interest rates change. But if the company is planning to hold on to that debt investment until it matures, it's going to receive that stated interest rate, most likely every 6 months, until maturity. So those market values or fair values really shouldn't matter at all. And it's because of that the valuation on the balance sheet is amortized cost. Market values or fair values are not relevant because the company is not planning on selling them before maturity. So how would debt investments held to maturity, if they're reported at amortized cost, in other words, the balance sheet completely ignores fair values, then how do these debt investments held to maturity affect the income statement? Well, all bond investments or all debt investments are going to generate interest revenue. What else could potentially affect the income statement? The only other things theoretically that would affect the income statement are 1, a sale of these investments. That's unlikely to happen because these are held to maturity. The other thing that can theoretically affect the income statement is unrealized holding gains and losses. But because these assets are held at amortized cost, we're not going to have any unrealized gains or losses. Debt investments that are not held to maturity and that are not where the company's intention is not to trade them actively are classified as debt investments classified as available for sale. Anything can happen with these. And because they can be sold today, tomorrow, in the immediate future, we want to give those investors the fair value. So we can think of these as the market prices. Record those fair values because we don't want investors to be surprised when they are sold with a major difference that could arise between amortized cost and fair value. But as a compromise, we say that those unrealized gains and losses do not need to go directly into net income. One thing that the income statement will report, of course, is the interest revenue. All debt investments are going to have interest revenue being reported on the income statement. Of course, when these securities are sold, We're going to see realized gains and losses going through net income. And that's all we're going to see going through the income statement on debt investments that are available for sale. So while this is not an income statement effect, I'm going to make a note because it's really important. These debt investments available for sale. Unrealized holding gains and losses, they are recognized because these items are recorded on the balance sheet at fair value. They're recognized but not in the income statement. So where are we going to see these unrealized holding gains and losses? Well, we have a special place for them that's not income, and that's called comprehensive income. Remember, comprehensive income is not the income statement. So they're reported in an account called Other Comprehensive Income. And this is a tricky account because the only reason this Other Comprehensive Income account is used is for these unrealized holding gains and losses. So the next question is, where can an investor find Other Comprehensive Income? The only place that they can find them is in which financial statement? Well, in one that we very rarely talk about. And why do we very rarely talk about this statement of comprehensive income? Because there's only 2 lines on the statement of comprehensive income, 2 lines plus their total. Those 2 lines are net income plus or minus other comprehensive income. So this statement of comprehensive income is only used by those investors who are interested in the unrealized holding gains and losses during the period. So one more thing, these fair values, the asset, investments in debt securities, is reported at fair value. Remember, we use that special fair value adjustment account, so we can think of it as the debt investment asset plus the fair value adjustment balance. But we're also going to see the cumulative effect of these unrealized holding gains and losses will be reported. Unrealized holding gains and losses throughout the period also impact something else. So they impact the fair value of the asset. But what's the other side of that entry? If it's a debt investment that's classified as available for sale, the unrealized holding gains and losses impact accumulated other comprehensive income. And where do we report accumulated other comprehensive income? Remember, this is reported as a part of stockholders' equity. That's it for our debt investments available for sale. The third category for debt investments is debt investments held as trading. These are the bond investments that the company has invested in, where they can sell at any moment. Typically, they're going to be sold within 3 months. Why? They're investments made on a short-term basis, and the company is going to cash them out, sell them for cash, either because they like the market price and they want to capture or realize any gains, or because they need the cash and want to, regardless of whether it's selling it at a gain or a loss, it wants that cash so that it can pursue potentially an operational investment, such as acquiring a subsidiary or expanding a manufacturing plant or going into a new business line. Because these can be sold at any point, they are valued on the balance sheet at fair value. Of course, because it's a debt investment, all debt investments have interest revenue being reported on the income statement. Of course, these are going to be sold, so any realized gains and losses are going to be reported in income. And because they can be sold at any moment and they are very likely to be sold within the next 3 months, we have unrealized holding gains and losses. They are reported in net income. This way, investors are not surprised when those securities are sold and when the unrealized holding gain and loss is actually realized. Investors are not that surprised. If you're looking at this accounting treatment and saying, I can't believe that it's this crazy, that the accounting treatment is based on management's intention with their investment. What if they're really not sure? Yet that drives what could be affected in earnings per share, the most widely used metric of firm performance. If you're thinking that this all sounds crazy, well, you're not alone. Investors have been arguing with the FASB over this accounting treatment for a very, very long time, at least 10, 20 years. And investors have been arguing, why don't we just have one simple accounting method where all investments are classified on the balance sheet at fair value with those unrealized holding gains and losses reported through net income. That way we don't have to worry about this, what we call a mixed attribute model. Some investments being classified some way and other investments classified another way. And the reason that hasn't happened is because mostly the investment banks that are holding much of these positions are coming back and saying, well, don't make us report if we have a bonds that we're going to hold to maturity. There's absolutely no reason why those unrealized holding gains and losses should be reported. Our earnings are going to be way too volatile. And they fought back and said it's going to be confusing to investors. Earnings are going to be way too volatile. And they're going to, investors that are using earnings to determine the value of our stock price, they're going to think that our firm looks much riskier than it actually is. And so their pushback has actually prevented us from having an accounting method that is a little bit more uniform across the different types of securities. All right, so here's the three methods for debt investments. We also discussed in detail one of the accounting treatments for equity investments. Remember, equity, we're talking about purchasing the common stock of another company. And the three classifications for equity investments are not based on management's intention. They're based on how much of the stock, how much of the investee's stock. We've acquired some shares of another company. What proportion of that company did we acquire? Or how much influence or control do we have over the company whose shares we just purchased? We start off with just regular purchases of stock. If I have shares of another company, I have no influence over that company. It's simply just a way that I want to generate return on my cash. We call that equity as securities that do not have or without significant influence. Over the investee. And as a general rule of thumb, it's not a hard and fast line, but as a general rule of thumb, the investor has less than 20% of the common stock in the investee. And we call this accounting treatment the fair value method because we value those shares equal to what they're trading at in the market. So that leads us to our balance sheet investment category here. They're reported on the balance sheet at fair value. Then that brings, anytime our investments are recorded at fair value, the next question is, what happens to those unrealized holding gains and losses? Well, because common stock is so heavily traded and those market prices typically are very close to fair value, those unrealized holding gains and losses are recorded directly in net income. What else can happen with stock? We're not going to get interest on stock, but what do we call those cash payments that we may receive when we're holding shares of stock? Dividends are recorded as revenue. And of course, as with any asset, realized gains and losses are of course going to be reported in the income statement. This video was simply a review of all of the accounting terms that we've covered in detail. In the next video, we're going to begin the new material by talking in detail in the next category for equity investments, where we have between 20 and 50% of the investee's common stock.